Some of the programs that I've had a lot of success and have had a lot of borrowers qualify is products like cashback mortgages. There's a new product called, co-borrowing
Ownership.
ownership. Yeah, so that's actually great because clients can, if they want to buy something for over $1 million or they don't have the
Buying
right
power.
credit scores to qualify for an insured mortgage, they can still buy with 5% down, and we can get the 15% from a co-borrower.
Right.
Then we have a rent-to-own programs, which is more your specialty, but that's really good for clients that don't qualify today. And then we have, extended amortizations like 35, 40 years for clients that need more purchasing power, more borrowing capacity, lower payments.
100% financing
100%
options.
financing options, borrowed down payment, so using LOCs and other products to supplement your down payment so you have enough money to close. So there's so many products.
And you forgot about the most powerful product that we used till date,
Which one?
our zero down program.
Yes.
So many buyers, we got homes with zero down, zero money
Absolutely.
in their account.
Yes.
And there are so many different ways we can do it using many different programs. And I can count at least 15 to 20 buyers we got homes
Oh, yes.
with zero money down.
Absolutely.
Sometimes people think it's a scam, it's a lie, it's just a bait. But we have done it so many times and it is real and it's legit.
Yes.
And it is just matter of time when you're open to the discussion, you want to talk about it, and we can explain how it's exactly done.
Yes.
And that has been a biggest success for us.
Yeah.
It's great. I feel like people are not open to like discussing. Like people are so they're so dependent on the banks. When they go to their bank and they sit down with the bank, nothing against the banks or bankers, like they sit down and they do their math and they go by the traditional way of financing, and they are not able to imagine that there is a world out there where there are so many other products from the banks, from the government, that they can utilize to increase their buying power, to get qualified and whatnot, right? So it's just the matter of time, like when people actually realize that yes, you need to be open-minded, talk to 5 agents. Just like when we get some kind of disease, right, we don't depend on one doctor. We have to go to like 2-3 doctors and see exactly what the diagnosis is, what's going on, and what is the solution. I think same thing applies to the mortgage or real estate world too. Next one on my list is the co-ownership program. We just converted a client a couple days ago.
Yes.
So let's talk about that client, like without saying the name, like we can talk about the fine details and
the situation
of the client.
So I guess this client, Nishan, that you had referred, lovely family, trying to get into their first home together, expecting a baby soon, growing family, currently renting. Landlord is trying to just, have them leave the property because I think they want to sell it or whatever. So I think their lease is coming to an end. They have to either, renegotiate with someone else, which is going to be a very high rent, or they have to, find another place to go. It's stressful, especially when the baby's on the way. So client, I think you educated them and said, hey, like it might be a good time to buy. And the client is very motivated to buy because they see the value and they see that there's an opportunity. Now, in this particular client's case, they have good income, good jobs. They don't have ideal credit. It's not bad credit, but it's not maybe good enough for them to qualify with less than 20% down payment and go the insured route, because mortgage default insurance companies like CMHC can be very particular about, how much they lend, what the credit score should be, and all that kind of stuff. So they don't want to deal with all these restrictions, but they want to get into home ownership and they don't have 20%. So this is where the co-ownership program comes in. It's a perfect product for these families because what it does is basically whatever down payment the client has, it adds to it and supplements it to get to a 20% down payment so that the client's eligibility can increase quite a bit, like exponentially.
Save the CMHSE fee and the 30-year amortization, lower monthly mortgage payment.
Yeah.
It's a win-win.
Even 35-year amortization in this family's case, right? So again, growing family, don't want this big mortgage burden. So I said, like, let's do 35 years up front. We can always come bring it down in the future when rates go down. So they love it. And co-ownership, the way it works is the equity partner that's going to come in and invest. It's an investor. So you have to know that part of your home is going to be owned by an investor. But as long as you understand the pros and cons and the ins and outs of the program, it's not a bad program. It's a pretty good program for the right client.
Yes. That way, they don't have that, stress of arranging that additional down payment or increasing their income in short span. Because investors who are the partners in this purchase, they are flexible in terms of increasing their buying power.
Yes.
So instead of going with the traditional 100 times or your income times 4, you can go with income times 5 or maybe 6, depending on their situation.
Yeah.
And they can have a huge buying power comparatively.
And partial home ownership of 50-75% is better than no home ownership.
Exactly.
So if it helps you get your foot in the door, I think it's an amazing product. And especially if it's a reputable co-borrowing company that actually has a demonstrated track record that's not going to interfere with the homeowner's, way of life. Those are the main things that, should be of concern to the buyer.
You don't want any issues down the road where there's
Exactly.
too much interference from the investor. You want it more of a hands-free investment.
Yes.
Where people have that feeling of home ownership. They don't feel like they are not the right owners. They're not the actual owners of the property.
Yes,
right?
yes. And that's why in that program, what we do is before the buyer actually goes and buys the property, we set up a meeting with that co-borrowing entity so that everything is very clear up front. All the terms and conditions are explained to the client, and the client knows exactly how it's going to work when it's time to sell, when it's time to take out equity, how that works. So all of that is explained. The math is broken down so clients fully understand it.
So there will be 2 agreements, one between the seller and the owner, and one will between the investor and the owner.
That's right.
And those both will be reviewed by the lawyer to help you understand all the clauses, and so that you're comfortable with what you're signing up for, and it's very straightforward.
Yes.
So this is an amazing product. I think this is new in the market, and I think it's going to be very powerful in the upcoming days.
Yeah. The right person who understands it and can really see the potential.
You have to be open-minded again.
Yeah, you have to be open-minded. But it's a really good product.
You have to understand the concept, just like first-time home buyer incentive. Government used to be owner of your property with that 5% that they're giving, right? So same thing over here, but you have an investor, but I think this is far more powerful.
Yes.
We have discussed about the co-ownership program.
Mm-hmm.
If people don't like the idea of going with the investor and they want to partner up and do it on their own, do you think it is happening very commonly, or it is not that prevalent?
It's happening in some cases. I think we have a couple of clients that are looking at potentially, partnering
together
up with friends and family. But I think the main thing that people hesitate about is they don't know who would be the right partner, and they're hesitant about getting into a partnership with someone that they may not feel comfortable with, or who's maybe not in that right time frame to buy at the same time. So finding someone who's trustworthy, plus who's on the same timeline as you to be able to buy today.
So
it's
maybe
like
a couple friends, or a couple family members, or a person that you know. Like, you have to know that person really well.
Yes.
Buy a home together with.
Yeah.
So instead of like waiting or having that, because see, your income is never going to be sufficient. If you make 100K alone, you will only qualify for 400K or 500K. We can find some ways of increasing that buying power by using all these different programs the lenders and the banks have. But we cannot get to that detached home or a semi-detached in GTA. You will have to partner up, and it is good to partner up, make that equity, stay there for 2-3 years, and then you can split the equity and you can move on with your life. You will easily make 100-150K from that transaction.
People who have done it have had a lot of success, and they're very happy because now they're sitting on enough equity where one person can either buy out the other person, or they sell the property and split the proceeds, and they now have enough to buy independent homes of their own. And one of the things that people don't realize, especially first-time home buyers, is that there's ways that lawyers can structure agreements. There's a word or a legal term for it. But there's ways which basically that agreement would basically dictate the terms of the co-ownership. So in the future, if let's say there's ever a dispute, there's going to be a way of how to handle that dispute. And it's all legalized. It's all upfront discussed. So that really takes away the stress.
Having a great lawyer is crucial in any transaction.
Yes, absolutely. So that eliminates a lot of the anxiety that people have, is like, what happens if one person wants to sell, other person's not ready? These are discussions to have with the lawyer, and these are questions that can be addressed and upfront, negotiated, before you guys even commit to buying together, right?
Let's get back to some of the programs that you outlined.
Sure.
And let's start with cashback.
Sure.
It's not the cashback that real estate agents give. It is the cashback that we get from the banks. Cashback that you get from the real estate agent is a different topic. We'll touch base into it maybe down the road, but let's get back to the cashback mortgages.
Sure. So cashback mortgages, there's two types of cashback when it comes to mortgages. One is the cashback that is like, you get a $3,000 cashback if you close with bank, let's say BMO or TD, and you have a mortgage of X amount, 750,000 or higher. That is more of just a promo that the bank has and has nothing to do with like how we can creatively help you increase your borrowing power. There's a second type of cashback, and that's the cashback we're talking about, where you can actually borrow anywhere from 3% to 5% of your mortgage. So if your mortgage is $500,000, you can qualify for up to $25,000 of cashback from the lender. And $25,000 of cashback is a lot of money. So with that money, what you can do is there's so many things. You can do renovations to your house. If you want to modify the house that you're buying, sometimes people might not find the ideal home when they're first-time home buyers.
Finish the basement.
Finish the basement, create a separate like income-generating suite. Closing cost, elimination of debt, which then helps you qualify for more. And banks, when they give cash back, they actually consider if the cash back is going to be used for debt repayment, they'll actually take the debt out upfront from the analysis, give you more purchasing power, and then direct the lawyer to actually
even the car loan, right?
Yeah.
It will bump up their buying power like substantially.
Yeah. And $25,000 is like a typical car loan debt. So if somebody's paying $500 a month and they have a $25K car loan and you use cashback product to actually eliminate that debt, not only are they getting into their home buying journey with less debt, but they're also now qualifying for $100,000 to $150,000 more, which can make a difference between buying or not buying, right?
Of course, yeah. And also they can use that to supplement the down payment. If there's a shortfall, maybe they have 10, 15K, they need additional 20, 25K, and this is the powerful way of arranging that that down payment and put it towards the home purchase.
Yeah.
And we have done it so many times.
Yeah.
Let's talk about 100% financing.
Yes.
So how do we get, I think it's more applicable towards the new construction, right? If somebody has booked a pre-construction, the closing is a couple years down the road. And if the value of the property at the time of closing, when they do the appraisal, is more than or at the value that they purchased it for, so there is a potential they can tap into that appraised or increased equity, and that they can use it towards the other purchase, right? Correct me if I'm wrong.
No, you're absolutely correct. Absolutely correct, except we've used 100% financing even for non-pre-con in some cases. And
Great.
Yeah,
I didn't know. Okay.
Yeah, it's not exactly 100%, but it's very close. So we'll talk about pre-con first. So there are some financial institutions out there that will basically provide up to 100% financing on a pre-construction purchase price, provided that the purchase agreement was signed over a year ago from the date of the financing or the closing, and provided that the value of the home has actually risen since the time of purchase. So
these are A lenders, right?
These are A lenders, yeah. So we have A lenders and B. So depending on the client situation, we will, and we have options for both.
Okay, great.
So what happens in that situation is, let's say somebody paid 10% in builder deposits, and they have purchased a property, let's say for $500,000. And so they've paid $50,000, and then they need 20% to close, but they don't have the money now, and they don't have money for closing cost. So what we can do is we can actually finance the full $500,000 purchase price, provided the property has increased to about $650,000.
Okay.
And then we basically get 80% financing on $650,000, not on their purchase price.
Amazing.
So we can actually get them their deposits back in some cases as well, which they can then redeploy again for renovations,
buying another properties or investing somewhere else.
Exactly.
That's amazing. And how do we apply this to the resale?
So to resale properties, 100% financing, there's a lot of solutions.
Has to be a long closing, right?
It doesn't always have to be a long closing. In some cases it does. So every situation is a little bit different, and we kind of plan with the client accordingly. But some of the programs for 100% financing are borrowed down payment. So without going into the specifics of exactly how that down payment is borrowed, banks, insurance companies certain banks and insurance companies allow use of borrowed down payment to fully fund the 5% minimum down.
Okay.
And then we have clients that sometimes have some gifted funds, and then some borrowed down payment is required. So basically between certain combination of certain available products, we can make up that 5%.
Okay.
And we can do 100% financing. So, if you have your closing cost, that's ideal. Or if you have 1-2%, like some savings, that's ideal. But usually these type of cases, you need a good credit score, and a good credit score is classified as someone who has 680 plus in Equifax.
Exactly.
At least one of the borrowers.
Okay. Well, this is great. This would be ideal for people like who are struggling with the down payment again. So I would say we have 3 or 4 different avenues of arranging down payment.
Yes.
As long as you have great credit score,
Yes.
your income is sufficient, no debts, no borrow well and all that insane amount of debts. They can easily borrow money using these 3 or 4 products that we have, and become homeowner. Instead of paying somebody else's mortgage, they can get into the place that they can call home, and then they can begin their home buying journey and make that generational wealth for their family.
Yeah.
Just by having that idea in their mind that they can be homeowner. They have to believe first, and then everything can happen from that point. What are some of the other mistakes the home buyers make instead of just waiting and waiting for the right time, or waiting for saving more money? What are some of the other mistakes they make?
I think one of the other mistakes I would say is not talking to the right people soon enough, waiting too late to get advice. Where, for example, if somebody's goal is to buy 6 months from now, the time to have a conversation would be now, not 6 months later when you're ready. Because what you think is ready, it's a long process. Sometimes things take planning. And if your situation is not ideal, we might need a little bit more time to guide you and handhold you so we can get to the point where you're ready to buy. That would be one of them. And then the second is just not doing your due diligence, like who you're dealing with in terms of your team, like who is your professional, who is your service provider, what kind of experience do they have? Have you even done the research or the homework, or you just like the person?
Yeah.
Person might be a nice person, but if they don't have a lot of experience, or they don't have a lot of resources to be able to guide you properly, then you're not going to get the right deal.
Yeah. Right? If we are in GTA right now, everybody knows at least 5 to 10 other realtors or 5 to 10 other mortgage brokers.
Yeah.
It is extremely competitive. You have to see who's the right fit for you.
Yeah.
If you give business to your cousin or your family member who does 1 or 2 deals a year, and you end up paying 100K extra for your property, you'll be paying the price for the rest of your life.
Yeah.
So it is very important to pick the right person for the job, do your research, and put your trust into that person.
Yeah.
And it's putting all your life savings into that investment. It's one of the biggest investment of your life.
Yeah.
Very important to find the right set of people to work with.
Absolutely. Yeah.
So coming back to the first time homebuyer incentive now.
Yes.
Why do you think it was such a failure? And they finally stopped it, thank God. In our 4 or 5 year long career, we never, maybe we did 1 or 2 transactions with the first time homebuyer incentive.
Yeah.
And it was such a huge failure.
It was a failure because the government, like a lot of other government programs, had a lot of red tape and restrictions on who is a qualified applicant. So, all these restrictions, what they do is they actually eliminate a lot of buyers. So we got a lot of inquiries, but people were just not qualified for that program. So
the income was limiting at 4.5, right?
Yeah, initially
4.5 times the income.
Yeah, initially it was 4.5. Now it's 4 times the income. So it's the 4 times or 4.5 times. So in certain areas it's 4 times, and in certain areas it's 4.5. Oshawa, I had a client recently, so someone who was buying in Oshawa was interested in the program, but then I found out that it's not part of the GTA region. So now I'm capped at 4 times.
I see.
So that 4 times now, if you do the math, clients qualified to borrow up to 4 times their income, but without that, they would be qualified for maybe 4.25 or 4.3 times. So now you're actually, the benefit is actually not having a positive effect. It's reducing their eligibility. And then it's also income restrictions. So clients who have income, higher than 150 or higher than 120 in non-GTA don't qualify, right?
So you're limited to 600K buying power.
Yes.
So 150 max times 4, you come to 600K max buying power, and you can only get condos in GTA. You cannot buy outside of GTA. You have to be in Greater Toronto area or Vancouver,
Yeah.
and that was very limiting factor as well.
Yeah, because the cap on the purchasing power doesn't align with the properties that are out there in the market, right?
If it was times 5 or 6, would make sense.
Yes.
But we understand that is not possible with current interest rates.
Yes.
But still, like that's why this program was such a failure.
Yeah, exactly.
Good they took it out.
Use the money somewhere else, I would say.
Yeah,
There's other ways to support people, right?
Bring affordable housing or whatever they can to
Yeah.
people. Were they able to achieve the budget that they set aside for this program? No.
I can't remember the exact numbers, but it was like in a certain billion that they had kind of set aside, and they were nowhere near that cap. Yeah.
I understand. So the few of the reasons that I can think of why the first-time home buyer incentive was a failure. Number one, the buying power was limited by your income times 4. You can only buy in Greater Toronto area or Vancouver, and you would only qualify for 600K home because the income cap is 150K, and you can only buy condos.
Yeah.
Right? So people who cannot buy houses were disappointed with this program. So these are few of the reasons why this program was such a huge failure.
Yeah. Good conversation starter, good attempt by the government, but like a lot of other programs, big disconnect between reality and the way the program is designed. It just doesn't work. Yeah.
I guess there was lack of awareness of the ground level reality by the government.
Yes.
They are the experts, they know what they do.
Yeah.
But I think they need to look at the actual numbers, like what is the average price of GTA or Vancouver.
Yeah.
Vancouver is even worse than GTA.
Yes.
So 600K, like right now we can't even get like a 2-bed in Toronto.
Yeah.
Unless you want to buy like a really old condo with high maintenance fees, yes. But it is extremely challenging to find something in that budget. You have to go outside to Kitchener-Waterloo, Oshawa, up north or London, right? So we can explore all the areas on the outside, but within GTA it is very hard to find something in 600s.
Yeah. And the other reason as well is like the government's incentive or the program, the way it was designed, it was meant to reduce the monthly payment of the client by having an additional down payment component.
Yeah.
But when you do the actual math and you see that, okay, that additional 5% down payment on let's say a 500K property is actually nothing. So the impact on the payment in terms of reducing the payment amount is not worth what the client is giving up in equity. So you might save like $50, $65 a month off your payment, but in exchange, you're giving up 5% ownership. So this
was a big factor. A lot of people didn't like the government is owning their property.
Yeah.
Even though it was a very small fragment, but still people don't grasp that idea.
Yeah, and especially when you give them the breakdown of the math, like this is what you're getting for giving up this amount.
Yeah.
It doesn't really make sense for most people, right?
So Shabnam, we spoke about FHSA and how it's better than RRSP program. Can you shed some light on it?
Yes, this is probably one of my favorite topics with first-time home buyers. So the FHSA, I would say, is probably one of the best first-time home buyer benefits.
In a long time.
In a long time. One of the government incentive programs that I would say is actually really good, and I'm glad they came up with it. So traditionally, the RRSP program was the program that we would recommend to everyone, where people would contribute money into an RSP, get a tax receipt, and then they could take it out tax-free, but then have to put it back in over the course of 15 years after the home ownership purchase. So that was essentially borrowing money from their own RSP. It wasn't really like them getting that benefit to tax-free, because if they didn't put that money back, they would get taxed on it. Now with the FHSA, they can actually... It's a lot of similarities to the RSP program, because what the client can do is they can actually put money in an FHSA, get the tax receipt the exact same way that they would with the RSP. But when they purchase their home and they have an accepted offer, they can pull out the money tax-free, and they do not have to recontribute the money back.
That's the biggest factor.
It's the biggest factor. That's a game changer. And when it comes to flexibility as well, like with RSPs, there's minimum vesting periods. So you have to have funds in the account for 3 months, and then you have to really plan out your RSP contribution and your home closing, and it could delay your home ownership journey. Whereas with FHSA, there's no such vesting periods. So it's less restrictive, which is really good. So for somebody who's paying, who's in the 44% tax bracket, an FHSA product, for example, could save them $3,000, $3,500 in taxes. And it's a quick opening of an account, putting the money in there, and then taking it out when you buy the house. So it doesn't take time, but it's a really good benefit, and it can save the client a lot of money.
So benefit number one is they don't have to put money back into the borrowed money that they took from their account.
Yes.
And secondly, they can contribute the maximum 8K per family member compared to 35K.
Yes.
Right.
Yeah.
So I think that's kind of a downside.
That is a little bit of a downside because with RSP, you get 35K of contribution room, provided you have that contribution room and you haven't actually used it in the past. So you have to check your notice of assessment to see if you have that capability. With FHSA, the limit is lower. It's $8,000 per year. But what's really important is, and the other big difference is with RSPs, let's say you haven't ever contributed, but let's say you've been working for 10 years. Your room automatically grows and grows each year. Right. So 1 year, like 10 years down the road, you could open that account and you could maybe have 100,000 of RSP room to contribute that into. With FHSA, you actually don't keep carrying forward that room. You have to open the account so that the timeline, because the timeline from when your actual room starts to accumulate, the contribution limit, is from the time that you open the account, not from the time that this program was set up.
Okay.
So for someone who wants to start or buy a house this year or next year, the time to open this account would be right now. All the banks have this product, and it's a very easy setup. Open it now, even if you're not going to buy this year. Definitely open it if you're going to buy, but even if you're not going to buy, open it so that the clock can start ticking and you can actually build up contribution room for this particular tax year.
Okay, great. So just to summarize, if anybody is planning to buy home in 2024 or next year, they should immediately open FHSA account and they start contributing towards it. Any bank, or I would say all the banks, have the permission to open this account. Yes. And you can contribute 8,000 per person and 16,000 as a couple.
Yes.
And it is completely tax deductible.
Yeah.
Whenever, let's say you collect maybe 40K in next couple of years, and the amount that you'll contribute towards your home purchase, you don't have to put it back into your, just like RSP, you don't have to do it.
Yeah.
And in that case, it becomes a very powerful way of saving that money towards your home buying journey.
Absolutely. And think about it this way. If you have 8,000 of savings today to put in, and you put it in today, and you get a $3,500 or $4,000 tax refund from the government, next year when you file your taxes and you get that refund, now for your next $8,000, the government is actually giving you a refund, so you can actually use that towards
instead of going on vacation with that,
put
it back into your account and use it towards your home purchase.
Exactly.
That's great. No, thanks. That is, I think, going to be a game changer compared to the RSP.
Yes.
There are so many downsides to it. I think they have worked on those and they have came up with this brilliant program.
Yeah. And you can use it in combination with RSPs. So if you have RSPs already, you plan on using them. It's both programs can be used together. In tandem, which is very powerful as well.
Yeah. So this is more like a combination of RSP and TFSA, if I'm not wrong.
That's right. That's what they say. Yeah. Because any growth that happens within the first home savings account fund, so let's say you open the account, you put your savings in it, and then the savings are invested in a GIC or a mutual fund, and that 8,000 becomes 9,000 before you buy, that growth is also tax-free.
That's amazing.
So that's the tax-free component of the fund that comes in.
Oh, that's amazing. 30 to 40 year amortization.
Yeah.
How do we do that?
So 30 to 40 year amortization, just to be clear, up to 30 years we can get with conventional banks. Outside of 30 years is alternative lenders.
Yeah, because for insured mortgage, we can go up to 25 years amortization. With 20% more. With uninsured mortgage, we can go up to 30 years.
Exactly.
And when we talk about 35 to 40 years, that is kind of shocking. And so spill your beans, like how exactly we do it.
So the way it works is alternative lenders, there's a few of them in our space and in our industry that have, I can't say they're the same interest rates as the banks. They might be at a 0.5% or 75 basis point premium. But if that can get the client a lower mortgage or help them qualify for more, then a 35 to 40 year mortgage in some instances does make sense, because at the end of the day, the interest rate environment we're in right now, we have to not just consider having a client buy a house and convince them that they should buy a house because market's going to go up. We also have to find ways to make sure that they can actually afford the home and they can actually
Yeah.
budget for that mortgage within their, like, whatever
Qualification.
dated, financial budget, right? So if, let's say, a 35 or 40-year mortgage makes it more affordable, I usually suggest it to them for at least a couple of years in this environment until interest rates come down. And then when interest rates are back in the norm, hopefully in that 2.5 to 3.5 norm that it's been for the last 20 years, then we can always bring them back to a 30-year amortization.
Okay. Of course, longer the amortization, lower the monthly mortgage payment would be.
Yes.
But again, debt is debt, right?
Debt is debt, yeah. But also, like, the lower payment also helps people qualify for more. So again, that's another tool in our toolkit. So that might help a client, again, qualify for that 50, 75, 100K more, which could make or break their decision to buy, because now they can see the properties they want to see, right?
Right, exactly.
I think there's one thing that I want to comment on with credit scores. A lot of the major banks have expectations of 650 or 680 or higher when it comes to insured mortgages. So if you're a first-time home buyer or even a subsequent buyer who's looking to purchase, and you don't know that there's a whole bunch of lenders outside of the big banks, you might go into your bank branch and be told, like, hey, you need to work on your credit, you're under 680, so you can't qualify today, but you can qualify.
Exactly. This was my next question, broker versus banker.
Yeah,
So yeah, continue.
So the difference between working with somebody like a broker like myself or a banker is that as brokers, we're not exclusively tied to just one institution. We can work with multiple big banks, multiple non-banks, multiple alternative lenders, private lenders. So our preference for our clients is always to be with what we call A lenders, which is the cheapest lender out there. Not necessarily just the big banks, because outside of the big banks, there's a whole world. Yeah, they have sister banks. There's these big banks are funding a lot of smaller companies that have the same rules and regulations. They're regulated by the same body.
Lenders, but nobody knows their name. Can you name a few?
MCAP is one. Lendwise is another one. Strive is a new lender that's come in the market that's destroying the competition. That's where we got the 591 approval. So it's a lot of these lenders. They're funded by the banks in some cases, and they have the same regulations. It's almost like, think about a bank giving a commitment letter, and we just remove the TD Bank logo and you put the other logo on there. So same rates in some.
There's a misconception. People think that they have to go with these big 6 banks. And if you go with other banks, it can be harmful for them, or it can be scary, or banks can close, whatnot, right? So we have these small sister banks, which are part of the subsidiary, and they are funding these small banks, and they're still A banks.
Yeah.
They're still A lender banks.
Yeah.
And they have better rates and better qualification criteria and whatnot, right?
Exactly. So in some cases, these banks are actually better. And I think the biggest misconception comes because you don't see their brand or their name out on the street like you would a TD or a BMO, right? And also, people don't understand that we're very heavily regulated. Like, financial sector in Canada is very heavily regulated. So we don't actually encounter lending institutions that have predatory practices that are like lending in that type of A space. They have to all abide by the same rules, whether it's TD Bank or it's a Lendwise, and they're all, again, regulated by the same body. So it's the same, if not sometimes better, for the client to go with a smaller lender.
And it has happened so many times with our clients. They
Yeah.
went with the smaller A lenders, which give better rates and better mortgage power.
Exactly. And like I've heard comments sometimes, like, clients will go to a CIBC and CIBC will tell them, hey, we don't use child benefit as part of income. Now, if somebody's getting $1,000 a month, that's $12,000 a year. $12,000 times 4.5 is like $40,000 to $50,000 of buying power that CIBC is not going to give, whereas another either big bank or non-traditional A lender will actually be able to provide. And again, that could make the difference between buying or not buying or getting into a better home, right? Yeah. So going back to your question, I think it's the biggest difference between a bank and a broker is having a lot of options for clients. And it's more about understanding what's the client's target price and target purchase price and whatever desire, and then finding the lender that's going to actually help get there, rather than looking at the bank policies and just restricting them to that,
I like your analogy that, instead of going to a BMW or a particular dealership, you're only limited to those incentives that are limited to that particular dealership.
Yeah.
You can go to a car dealership where you have all the brands under one roof, and you know all the ins and outs of what's happening, what's new, and what kind of new rates are there, and you can take benefit that way. So I think that's the biggest difference between the broker and the banker.
Yeah, yeah. I stole that analogy from another top broker that's a colleague of mine. Okay. But basically, like, you know, what the saying is that BMW, if you're buying a car, BMW, and you go into a BMW dealership, they're not going to tell you that Mercedes has a better deal, or that they're having a recall, or they're potentially having a recall or issues, right? So they won't talk about their issues, and they won't tell you the benefits of a competitor.
Going outside.
And it's not the person at the dealership's fault. They just don't know. They're just trained to talk about their products. Whereas the client could be missing out on deals at a competitor that they should have just like explored a little bit more, and we can help navigate them.
Amazing. A lot of times we do the consultation. Like you said, it's free from our side as a realtor too. They say nothing is free in Canada, and buying a home is absolutely free. You don't have to pay commission to the real estate agents. You don't have to pay commission to the mortgage agents, and you can just get the guidance, find the right person, interview a lot of people that are in your circle. These days everybody know 10 agents, right?
Yep.
So you need to do the research. You need to know how active they are, how many deals they do, and how they do the business. It's not the time in the market, it's not the volume, it's the quality.
Yep.
Like what is their Google ranking, how active they are on the social media.
Yep.
All these things play a role, and these days I think people have started paying less attention to Google reviews and more towards the Instagram, TikTok and all that, and they want to see in real life what you're doing. Right? And that's the whole point why we're sitting here. So
educating clients.
Educate.
Absolutely.
Yeah. So coming back to my point, so when clients, they come meet me or they come meet you, we give them everything we can. We do the session, we educate them, we provide all the resources, give all the math, show them the properties on the computer, like, or email them like this is what you can get, show them the real picture. Sometimes they have different ideas of what they can get, and we see them ghosting us all the time. Is it common with you as well?
Yeah, unfortunately it's very common. It's unfortunate because sometimes when we're educating clients, we don't know what kind of preconceived ideas or notions that they might come with, or what kind of insecurities they might have, right? So when we're, being transparent and we're telling them the truth and saying this is the path, sometimes they don't, if they're not open with us and let us know that this is what I was afraid of, or this seems way too complicated for me, it might be easy for you as you're explaining it, or it just, there's an easier path in their mind that they haven't maybe brought up to us that they think might be easier, then we can't really help them, right?
Yeah.
So I think it's open communication, being transparent, and at the end of the day, if somebody provides you a better solution and somebody provides you with better advice, all you have to say is, you know what, I found someone else and I think I'm more comfortable with them.
Simple
and that's
as that.
okay. Simple, right? Ghosting us, when somebody has invested time in you and somebody's, sat down with you and just gone over all the ins and outs of financing or in real estate purchases, it's not a nice thing to do. So we just encourage open communication.
I thought it was only happening to us.
No.
So
I think it's very common.
It's very common.
Yeah.
See, in the service industry, we are expected to return the call as soon as possible, return the message, emails,
Yes.
respond them back as soon as possible, and give them all the service, the top of the world service, right?
Yeah.
So that's what we do. We come to the meeting on time, all suited and booted, and we provide all the things that they need, all the resources, all the education, and go through our presentations and provide, you name it, everything, right?
Yeah.
And then and next day they never pick up your call.
Yeah.
You call the following week, no response. You message, no response.
Yeah.
Completely out of the picture, right? So just imagine how it affects our mentality, how
Yeah.
hard it is to go next time to service another client.
Yeah.
Yes, next client, everybody's different, right? So next client might be like a real person and he won't ghost us and work with us, but it is very hard to carry on.
Yes.
Very hard to keep putting the same effort and same energy into the next buyer or seller, hoping that they won't ghost us, right? So it is a very serious matter, and it takes a lot from us as service providers to keep giving our 100% every single time if somebody's going to work with us or not.
Yeah, absolutely.
Right.
Yeah.
So yeah, it's unfortunate, and I hope we give out this message and people actually start realizing. Go for consultation, whoever it is, whether it's lawyer or your realtor or your mortgage broker, whoever it is. Just let them know you have found another way, of you have found another person, your plans have cancelled. It's just a matter of one small text.
Yeah.
That's it. That's all it takes.
Yeah.
And that gives us a closure, and we can move on without expecting anything in return. Because when we give you that consultation, we are not actually asking you to work with us. Maybe you thinking about it. Maybe you need to buy home in 6 months, 6 years. Who cares? But you have to have that communication. It's very nice to have that sort of communication to help us, understand what's happening.
Yeah, and it gives us feedback too, right? Because in the service industry, especially a busy service provider, time is the most valuable asset.
Exactly.
So if your time is not being valued, or you don't know, what just went wrong, then it is disappointing, like you said. And sometimes, if you share feedback, you might actually learn something, because we might have something to say about that, and say, educate you further on that particular
Or if there's
topic.
something lacking on our end, we can improve ourselves, right?
Exactly.
It is a good thing to have.
Yeah, absolutely.
I would rather spend that time with family, or doing the stuff that I love to do. We have life too. We go to gym, we go play sports, we go out with the family, have a dinner.
Yeah.
And people think that the time of realtors or mortgage brokers is not as important, and they want to get all the information, and then don't respect the time, basically.
Yeah,
right?
absolutely.
And with us it gets even worse, because it's not that consultation. After that, we have to keep sending the properties, we have to keep calling them to get their feedback on the properties. We have to take them for the showings, we have to put offers.
Yeah.
And then one day you realize that person is gone. So
Yeah.
it is very hard sometimes to move on from that.
Yeah, absolutely.
Yeah.